Good afternoon, everyone. Happy New Year. As we sit here on the afternoon of January 8th, 2025. Before we kick off this New Year's session, we need to hear from the legal side. Okay, great. Well, Happy New Year, everybody. Hope you had a great Christmas and a great holiday season. I trust that everyone did. Before we get into our new questions, let's get caught up on last month's and see where we are, and maybe a little wrap up on 2024.
Sure, I'll take that one. And yeah, good to be here, Todd. Good to see you. What we've been talking about for the last few market insights, maybe even more than that, is this battle between reflation and inflation for regime leadership. So both focus on inflation reaccelerating. So we've been talking about that since the summer, really. And so nothing changes there in terms of starting the year. The question we're asking, because we've been kind of riding the middle in portfolio construction of both, which is sometimes the right thing to do. But the question we see as important now is what happens with economic growth in the first quarter. If it slows, that would point to inflation or quad 3, maybe stagflation, depending on what you want to call it. And if growth accelerates or reaccelerates, that would be reflation. That would be like quad 2. So that's really the question we see as the important one going into the first quarter, and how that's going to impact different markets and different pricing. So that's the update from last month.
Great, Rich. Any input on that?
Yeah, I would just add, if we go back probably 5 or 6 months, we've been kind of telegraphing that inflation is going to inflect and begin meandering higher. That has played out. The Fed's no longer expected to cut. I think it got up to 6 times. As of now, they're probably going to cut, or at least markets are priced for them to cut one more time mid-year, and then that's it for the year. And I wouldn't be surprised if they end up not cutting anymore, at all. As this quad 2 versus quad 3, and the important distinction is quad 3 ends up with a tendency to be more risk off, for stocks and bonds. Quad 2 is good for stocks, bad for bonds. And if the move to quad 3 is kind of a shallow one, meaning slight deceleration, stocks should be okay. If it's a deeper move where you have a more pronounced slowdown, those tend to get risk off, kind of environment. So, since we're at the beginning of the year and everybody's putting out forecasts, we'll use this as an opportunity to say why we don't forecast. And that a forecast is just a single scenario. I expect this and this and this and this to happen. There are a lot of different variables at play this year, particularly when you add in the policy changes. And our job is just to use our market signals and try to remain in alignment with whatever the dominant regime is. If you look across global assets, currencies, if you only look at global currencies, it's a pretty consistent quad 3 message. If you look over to commodities, it's mixed. If you look over to stocks are trading more like quad 2. And if you look over to bonds, they're trading like they usually do in quad 2 and 3. So there isn't a clear consensus across all of global macro, which is part of the reason why the signals show regime leadership tied between quad 2 and quad 3. And it's just a matter of tracking these developments and making adjustments, as they unfold.
Well, that's great. Good update. And we had a strong equity market last year. Bonds a little kind of a mixed result, and we'll talk a little bit about that. But with the new year upon us, what is your view or big picture or macro view on markets? What asset classes do you think look favorable coming into the new year? Are there sectors that you feel better about? Some sectors better than others? And, one thing I think a lot of investors want to know is, the U.S. has been the dominant regime here. Is this maybe the year where foreign stocks or international stocks emerge?
You want me to go first, Rich?
Yeah, go ahead.
Yeah, I think not much, to be honest, has changed. We saw some inflection in the summer and the fall, and we're still riding those themes into this year. And as the first quarter unfolds, I think what we're seeing, those things can change, right? We could get signal shifts this quarter where we could have that conversation maybe next month or the month after, where we say, oh, wow, we did see a change that we want to indicate to you. But what we do think is important is that the range of outcomes that is about to be underway in the first 100 days of this new presidency, this new term, we think that has the potential to open the door to increased volatility. That's not necessarily a bad thing. It's just there's going to be more outcomes potential this year than maybe last year with all these policy changes that Rich might touch on. And so for now, I think the equity market has been strong. It still looks fairly strong, but again, the part will be about the economic growth. What is that going to do? We see what the inflation side is doing, but what's the growth side going to do?
Now we have growth slowing, which is quad 3, but not as much as consensus. So it's possible that consensus has to move up on both growth and inflation. So, if growth slows and inflation reaccelerates on a sequential basis, that, is the definition of quad 3. But if the street is low and they have to take their estimates of both growth and inflation up, that could have a quad 2 flavor to it, because that's going to generate, or you would assume that would generate, some flow. So, we see the regime leadership as a tie. There's no clear, leader at this point. But, in preparation for quad 3, things like, at least on the stock side, things like energy, financials, quality, companies that don't have debt, that are benefiting from high interest rates because they're sitting on a pile of cash. That's a totally different profile than a company that is heavily indebted and will have to go to market this year to refinance debt, that matures. That's a very different outcome. So high quality names, should weather what could be a more volatile year. Low volatility utilities, that would kind of be the quad 3 playbook. And I mean, Gavin mentioned a wide range of outcomes, and that's probably an understatement, given that we're looking at, 4 very major policy developments. You have tariffs, you have immigration, you have deregulation / spending cuts. I'll kind of, combine those for now, and then tax reform. The executive actions are likely to hit first, and that would be tariffs and immigration. And we don't know, and I don't know anybody who, has a crystal ball to predict, is Trump just using tariffs as a negotiating ploy? Is he going to go to a country and say, you do A, B, and C, or else tariffs? And what happens is they do what it takes to avoid the tariffs. And from a market standpoint, markets will sell off on the threat of a tariff and then bounce back if the tariff never materializes. But to the extent that tariffs are imposed and restrict global trade, that's going to impair growth. That would add to the quad three scenario, or it might deepen, what would otherwise be a shallow quad three. And on immigration, same thing. There, probably 4 million people who are in the labor force are here illegally. So I don't know anyone that opposes, deporting people here illegally that have committed crimes, and there's no question about that. But there are also a lot of people that go to work every day like we do that happen to be here illegally because our legal immigration system is broken. And to the extent that there is, mass deportations where you could get some good workers, tossed out in the mix, that would tighten labor markets.
Mm-hmm.
So it's almost like the things that can be done through executive order are going to happen first. The things that have to go through the legislative sausage factory are going to happen second. The two things that can be done with executive action carry with it, some risk that it's going to impair growth. A tightening labor market and higher tariffs, would do that. And then the things that would be delivered through tax cuts, and spending cuts / regulatory reform, may come second. So that's kind of adding up where it could be a bumpy year just based on the sequence. So you have the size of each of these initiatives. You have the scope, and you have the sequence. And you can configure those in a way where the sequence happens, where the good comes first, then the bad, or the bad comes first, then the good. It just, remains to be seen, which is why, we always kind of fall back to, let's track what the current dominant regime is and make sure that we're in alignment, with it. Because we'll get signals from that as to whether, the market impact of any of these policy changes are going to be, kind of plus, minus, or neutral.
Well, tariffs have been, kind of forefront here along with the deportation. And the last part of that question was, and clients have been asking, those who are allocated to foreign or international stocks, could we assume that obviously tariffs could have a negative impact, not only on our growth, but certainly could hurt, companies or could hurt investments or foreign stocks? Would you concur with that?
Yeah, I would agree with that. And I didn't answer that last part of your question. It doesn't seem at this point that international, is ready to make a run. In fact, throughout the course of, say, the last month, we've seen almost one by one signals weaken, for major, international markets, to the point where only like, Canada and China still look bullish. Everything else, is kind of neutral. So there seems to be kind of a wait and see as it relates to, international. Now, going back to a lot is, focused on the spending cuts. And I think that kind of misses the point. When you look at Social Security, which you're not going to touch, Medicare, you're not going to touch,
Right.
interest on the debt, you can't do anything about. The amount of spending, the slice of the pie that's discretionary spending that could be reduced, just simply isn't big enough to close the deficit. But that misses the whole point. The whole point is you have thousands and thousands and maybe tens of thousands of pages of regulatory code that are unconstitutional when viewed in light of last year's Supreme Court announcements. So there was a precedent that if there's any ambiguity in legislation, it's up to the agency to provide the interpretation. Supreme Court said, no, that's not how it works. It's up to Congress to clarify it. So what I'm expecting is you just get a slew of executive actions to X out thousands of pages on the basis that they're unconstitutional. I don't think there's going to be any effort to say, well, let's go through and see which ones have some merit, or let's maybe this would make sense. We'll keep this and we'll get rid of that. I think they're just going to draw a line and say anything that can't pass the constitutionality test, it's gone.
It's limited.
And it gets thrown back over to Congress, and then Congress is going to have its hands full trying to get things, voted on and passed. Now, the regulatory burden on the private sector, the estimates vary. So, Competitive Enterprise Institute is out with a number that says it's $2 trillion. I mean, that's more than the corporate income tax and the personal income tax combined. So there's a huge burden there. And if those get lifted, that's going to be, I think, really powerful. And the thing to watch is, does it generate business investment? So, the conventional view is, well, let's look over here at the consumer, because if the consumer stays resilient, that's going to kind of keep the economy going. The thing really to look for, and particularly in a year like this with, so many big potential policy changes, is, does it start to energize business investment? And if that's the type of thing that happens where all these regulations are lifted, that would be something that would, help reaccelerate growth, where, we might completely avoid a quad 3 and markets start front running the fact that, less regulation means more business investment, which means, more growth down the road.
Right. Very interesting. To conclude today, and I think it's important as we kind of enter the new year here, clients start to think about their allocation or what's going to perform, what's not going to perform. And as we don't, like you said, we don't try to predict what's going to happen. That's a fool's game. But the general investor, if you talk to them, they focus on the stock market. They certainly have maybe a good understanding of how the S&P has done or how stocks have done. And they're clearly aware and are kind of understand how, and oftentimes frame everything to the stock market. But many of our clients and many investors, certainly many of our investors also own bonds, and bonds have struggled, here the last 2 or 3 years. And it does make up a big portion of many clients' allocations. So where do we see bonds, and how do bonds react with, policy changes, and just in general, how you see, the fixed income markets or areas of the fixed income markets that you think might perform in the current environment?
I think it's going to continue to be a difficult year for bonds. If inflation is reaccelerating, and at least as of now, we have it going not only to the mid 3s, but the upper 3s. That's one thing. It's just a headwind. Quad 2 and quad 3 are a headwind for bonds. And this would mark 2021 was negative for bonds. 22 obviously was. 23, thanks to that fourth quarter pivot by the Treasury, they ended the year positive, slight positive. 24 was negative, and 25 were off to a negative start. Rates have backed up about 75 basis points since the Fed cut, and the market is thinking that it's not agreeing with the Fed. Here they are cutting. They seem committed to cut again. Meanwhile, inflation is going against them, which we've been calling out now for a number of months. The other thing is that the Treasury has an awful lot of debt to sell. We've talked about the quarterly refunding announcement in the past. I think that's going to come back and play a role this year. And from fourth quarter of 2023 and all through 2024, the former Treasury Secretary, rather than issue long-term bonds, issued T-bills to fund the government, to fund deficits. And all it did was pull money out of a facility at the Federal Reserve, the reverse repo facility, which meant it had no impact on liquidity. So each quarter, they kept issuing more and more T-bills, almost as if to postpone the day of reckoning, and kick the can down the road to the next Treasury Secretary. Well, the current Treasury Secretary has been critical of that move by the former Secretary throughout the last year. Now that he's in the seat, does he do the same thing? Is the temptation going to be there for him to just do the same thing and say, well, there are signs that the market cannot absorb the amount of treasuries we need to issue to fund the deficit. Therefore, we'll do the same thing. We'll issue T-bills. And there's just not enough money left in the Fed's reverse repo facility to fund that. So maybe they have one more chance. End of January, beginning of February, we'll get another announcement, and we'll see. So, there's one view that says they should just rip the Band-Aid off and go back to issuing long-term debt. That's going to push interest rates up again and be really bad for bonds, but it gets it out of the way. It gets the pain, out of the way. And then if the market can look ahead to, deficit reduction, then they could turn the corner and have a positive, second half. But I think the setup now is that, given that we'll get a chance to update this next month, the view now is that, bonds still don't look good, from where I come from.
So if you are a bond buyer or a bond investor, you're staying short on the curve, and you're conservative.
Yeah.
Right. Well,
short duration, kind of the 2-year looks interesting. So something around 2-3 year duration, higher quality. And just, kind of ride it out where you have, you're not exposed to long rates going up.
Right. Well, and I'll tell you, it goes to show you for the 60-40, 60 equity, 40 bond investor, thank goodness for stock performance, because 40% of their portfolio, unless they're hedging or doing some more exotic type things, they're really struggling. And it looks as we speak here today on January 8th, that struggle, continues at least, in the early part of the new year.
Yeah, and that's a case for the kind of active risk management, that we do,
right?
Not just on the equity side, but importantly, the fixed income side, because the negative correlation between stocks and bonds, which is what allows that balance, the improvement in risk-adjusted returns, to be there for you, only holds when you have inflation under 3.
Right.
It starts moving above 3, then it breaks down, and it goes positive. And right when you think you have bonds there to, provide some kind of stabilizer,
right.
Bonds are the things that get hit. So, we may have that to, contend with for quite a while. So it's just a case for active risk management.
Well, that's great. Good update. We shall see. It's going to be a busy first quarter with a new regime. We're going to rename the Gulf of Mexico. We may be invading countries. Who knows what's going to happen?
Could we get naming rights on it? Could we call it the Park Edge Golf? What would that call?
Right. No more French fries. We'll call them American fries. I mean, it's it's going to be fun to watch. So, well, guys, thanks a lot, and look forward to how this plays out. And we'll talk to you in February.
All right, sounds good. Have a good day. Happy New Year, everyone.
Have a good day.